Good morning, ladies and gentlemen. Well, by my calculations, we're around -10 to -8. So the risk dial is actually doing considerably better and in danger of giving a buy signal for the first time this year. What could make risk on happen over the course of the next couple of weeks? Well, obviously we have the Fed on Wednesday, and I will concentrate this week's video very much on what the bonds are likely to do and what the yield curve could signal. Twos tens have had a quiet week. We haven't really had any movement. We are still below this 11 basis points negative, and therefore while that persists, the pressure is all the way down to -50. That's all that can be said at the moment, but I think there are going to be some big moves in the twos thirties and the twos tens by definition. What the Fed does now is quite important. If it sticks to 75s in terms of hiking, that is going to be very conducive to a negative yield curve and a continuation of the flattening. It will signal that the Fed really does not care, that it's it has the bit between its teeth, and the more that the market is convinced of that, the more that will drive the yield curve negative. If it now does a 50, is it going to be the end of the world? No, but we will probably have a bit of a sell-off in the longer end compared to the shorter end, because the market will start discounting that we are very close to the terminal rate that the Fed wants. So if we get a 50 and then we can start speculating that we're only going to get another couple of 25s until year end, or maybe another 50 and then a 25. So we are very, very close to the terminal rate that the Fed wants. And that is going to drive and stabilize the shorter end, but it's not going to stabilize the long end, because the long end is going to have the possibility of greater volatility if inflation does not stabilize, and we'll look at that now. 530s on a weekly basis have shown what I've been saying for a while, that the move is going to be in the 230s. It's not really going to be in the 530s. The move is going to be in the 530s only when the market is convinced that we have topped in rates. And I don't think that the market can come to that conclusion anytime soon. Even if we get a 50, and even if we get speculation that the terminal rate is quite close, the Fed, my contention is that the Fed will not turn any time soon. The turn in rates is not going to be even until the second half of next year. We could be in for a protracted period of stability at certain levels, and that is not conducive for the fives to start leading, or the twos. So I don't think that the major moves are going to be in the 530s. I could be wrong, and the only way that I could be wrong is if we start going through this level, which I've marked in red, which is 11 to 12 basis points negative. We are nowhere near that, and we have plenty of time to watch the market trade before we need to come to that conclusion. For the time being, I think there's going to be stability in the 530s. It's too early for the fives to lead. If we look at the individual tenures as opposed to the yield curve, you will begin to understand why I think that it's unlikely that the fives lead. We are basically in a holding pattern, and I think that we will stay within these ranges. To me, this 267 level in fives is going to be very difficult to break, and really 299, let's call it 3%, is also going to be very difficult to stay above. I just don't see the Fed giving a clear enough signal. You know, I could be wrong. We'll wait for Jay Powell's presser to reach firm conclusions, but it just seems so unlikely that the Fed would turn on a dime. And even if a 50 happens, there will be further 50s or 25s. And that is going to get us to a terminal rate around 3%. I think it's too early as a result to go for a completely negative yield curve below twos. If it does, it's going to be very minor, 10, 20, 30 basis points, and it's more likely to bounce off the 267 and go fill gaps around 303, 305. It's just very, very unlikely that we go through 267. To me, we are getting quite close to the bottom of the trading range. If we go to the tens, well, it ticked perfect at 273.9 on Friday. Out of everything, this is on the dailies. This has got more likelihood of it coming down and testing, for example, the 261, but still it's going to move back towards the 298 area. Everything is showing me that the yield curve wants to go more negative, but I just don't think it has the energy to do that. To me, the Fed is going to take a very, very long time to turn unless the economy falls off a cliff. And I just don't see that happening. I just don't see any data that is indicating that. So, you know, this kind of thing, which I've been saying for quite some time, you trade the range 274 up to 298, 303, and you keep on doing it. You fade moves down to 261, 262, because I think that is probably as far as it goes. If we look at 30s, that is actually showing more stability. And ticked perfect again on Friday, 294. I don't think that we can really bust through with any kind of conviction. I mean, can we go to 271? Yes, and have a curve, say, at 3% in the twos and down to 271 in the 30s? Completely possible. But to me, this level becomes a swing level, and anything that we go and trade underneath, we will make up at some stage over the course of the next few weeks. Something like this, possibly, or something like this. I just don't think that the downside is going to be sustainable beyond 271. So anything that comes down here will revert back to 294, and that is what I would very much bet on. The likelihood that the market is going to force the Fed into easings while we have QT, while we don't have data that the inflation rate has turned, to me is ridiculous. And down here, if we see it, 271 is going to be a great level to look for, possibly 320 again, but certainly 294. The one yield curve which should flatten further is the European curve. We got a nice aggressive move of 50 basis points, which very few people were expecting. Yeah, I was half expecting it. Did I think that we needed to get 50? No, because I know that this is the start rather than the finish of rate hikes in Europe. Anybody who tells you that they're not going to hike again when they come back from the summer recess, I think is on pot. And therefore, I think that the likelihood of the 2-year note doing anything at these levels is, minute. Can it come down and fill this gap, and stop everyone out and just trade basically in futures terms just above the figure and stop everyone out? Yes, it can, but it's not going to last. Another bad CPI, and you will see this trading back up here around 75 basis points. The twos are very vulnerable at this level, very vulnerable indeed. Do not think that they can stay at these levels for very long. I mean, the summer is long. You've got the ECB are on holiday. Unless the Fed does something ridiculous, the twos are really not going to move out of this range, say just above the figure in futures and all the way down to 25-ish in futures. So probably even sell in the money calls there and just wait for it to return towards the 75 area. If we turn to the bubble, what I'd love to see the bubble do is take out this quadruple bottom or whatever you call it, get everybody bulled up and then come back to around 96. It's too early for the fives to lead, but it's not too early for the yield curve to flatten. So if we just go back to the twos for a second, they're basically 40 basis points. If we go to the fives, they're 75 basis points. So you've got a positive yield curve of around 25. I think that by the end of the summer, that yield curve is probably at zero, the twos, fives, something like that. It's or not very positive. And if we go to the tens, this is where it has the most room to flatten. The tens could come down to around this kind of area, 65, 60 base. That's 85 to 75 basis points, and then bounce off it and trade sideways. It's not going to go a million miles to the downside. I would be shocked if by the end of the summer we are not above this level. Okay, so to me that is very, very unlikely, and because we are only starting the cycle. When you start the cycle, you can bet on a flattening yield curve, but you can't bet on outright falls in yields. That to me is very, very unlikely. And if we move to France, which is probably the clearest, can it come down to here, 138, 139? And basically bugger around all summer around this kind of level with 167, 170 as the high, and this kind of 128 or maybe 113 as the low? Absolutely it can, and I think it's more likely than not. But that is a sign of a flattening yield curve, a yield curve which is saying we have probably reached terminal rates in the very long end, and unlikely that we have reached terminal rates in the short end. The one low risk trade that I see in the euro dollars, and it's a very low risk trade, is EDU22. I mean, now the Fed funds target is what, 150, 175. Even if they do a 75, that's 250. And even if you put in another, pencil in another 50 basis points before it expires, that is still 3%. It's very unlikely that we get a settlement which is below this 96.63 level in euro dollars. I think the panic of accelerating Fed hikes is over and is unlikely to happen for again for quite some time. I think any move, if the Fed moves 75, let's say, and these sell off even 10 ticks, I think it's a great risk reward to buy them around the 50 level. I'll enlarge this part of the chart so you can see it. I am convinced that they are going to settle somewhere around 75 or higher, i.e. around this level up to 95, up to 9700. So between here and here, this is where they're going to go out by the end of the summer. So any dip here, buy calls, buy outrights, I think it's definitely going and will trade this higher level, which is 96, 92, 9700 by the end of the summer. Pretty damn sure. I just don't see the possibility that the Fed is going to be that aggressive or their pressure is going to be that bad that we need to worry about what the front month of the Euros is going to do. Convergence is going to take it up to these levels, I would bet. The dollar, what to say, basically bounced off 106.25, is just working off the extreme overbought levels that it had. You can see here how overbought it was on the dailies, and all it's done, it's, basically worked them off. And already all the other indicators are coming down into oversold levels. Fundamentally, what I think is that the dollar might not like a 50 basis points. It would mean that the Fed is decelerating just as the ECB is getting going, and people might start speculating that the interest rate differential between the two is going to start coming in, and that could quite easily bring the dollar down to retest these levels around 103 very easily. I just don't, if we turn that over to a Euro USD, would anybody really be shocked by a retest of these levels around 104.60, 105.20 on a weekly level, 104.37 or something like that? No, I mean, why would anybody be shocked by that? People get stopped out, it refreshed the pause that refreshes kind of thing. So if a 50 basis points comes along and the pressure is not hawkish, I would have thought that they will try to stop everyone out. And as we all know, when the dollar takes a pause, then risk can actually do slightly better. And this is that differential in tens US Germany, as you can see, just keeps on failing at this 181 level, keeps on failing. Now, if we get a 50 basis points, could it come down towards these levels, 160, 157? I think that's a given. I think that's almost a given. The interesting thing will be if it starts making new lows. That would be a bit of a surprise to me, and that would indicate more weakness in the US dollar, which would be very welcome by the EEM and by risk assets. But I think it's unlikely that it's going to happen, because that would mean that I'm completely wrong in my view in 10 years, for example, where I told you that it's going to stop and basically trained in a range. It would mean that 10 years US are really just coming off at the rate of knots. And I really can't see that happening, because the Fed is in the mood it is, and inflation is what it is. I don't think that we're going to start coming off at the rate of knots before the data conclusively shows that CPI has topped and is coming down at a very fast clip, and therefore the Fed can moderate, or the Fed says it, that they're convinced, and therefore that can happen. But I just don't see that the likelihood of that is very high, and that is why I think that the Dixie is very, very likely to stop at around that 103 level I just showed you a while ago, and it is more likely to rally from that level than not. Well, technically gold has done what it should have done, i.e. taken out these stops and, reverse back in. If I'm correct and the Dixie comes down towards that 103 level, then we are likely to test 1764 again on the upside, and probably even this kind of level, which is around the 1810 area, 1800, 1810. But it'll still be for sale. It'll still look awful. I just don't like gold as a hold here. I think it's a trading range. I think it's a trade. I think it could easily come down to these kind of levels around 1600 to 1550 over the longer term. And that's why I think probably doing put spreads, should it get to, around 1800 to 1810, is probably the trade. Another reason why I don't think the bonds are likely to rally very much in the next couple of weeks, or certainly over the Fed, and please revert back to what I showed you in 10-year notes outright and 30-year bonds outright. This spread is unlikely to go much further, but a little bit of back testing would be nice. And if that happened, and we can have a look at copper, which I said, I'm picking up at these levels. Copper comes back to around 350 to 367 over the course of the next couple of weeks, and that enables gold to go up to the level that I've just showed you between 1764 and 1800, 1810, and that spread between gold and copper just goes sideways, and bonds go sideways, and then we'll be ready for the next move, which again I think it'll probably be lower again and then finally up. So that is the kind of how everything fits in between copper, gold, the US dollar and bonds. That's basically my overall macro view. Oil keeps on trying to go above 100 in the front months, and it just can't. I don't think it's going a million miles to the downside, but what I think is that the US is on, it's in the US's political interest not to let it go any higher, or basically to keep it stable for the next few months until the elections are out of the way in November. With the Fed tightening, with demand coming down, the pressure, and the releases from the strategic reserve and blah, 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 the Saudis begging them, and, the Russian war not going too berserk, I think the pressure is going to be to the downside, or at the very best sideways. Something like this. Do I think it goes below 80? No, I don't. And if we look at DBC, which really is 99% subject to the moves in in oil. On a weekly basis, we are seeing the same pattern here as we are seeing in everything else. And I think 24.39 is going to be key. If we start breaking below 24.39, I think the bonds will respond, the long end of bonds will respond, and the yield curve will go more negative in the US, and it'll go flatter in Europe. I think it's going to really affect the yield curve if we start breaking below 24.39, and bonds will like it. But I don't think it goes much further than this kind of 23, this kind of level, 22.50 to 23, and that is going to have a limited effect on bonds. It's really not going to be able to get them very, very far. If we have a look at 30s, I think then if that happens, we will trade this 271 area. But I think it's fairly limited, or maybe these tops around 263. But I think it's going to be very limited, and we will come back to 294, whatever happens. The market that will like a 50 basis points most in the short term, i.e. on a spiky kind of way, is the SPX. I think, it comes out that it's a 50. Equity traders, because they're not all that bright, are going to say, yay, it's all over, and go and trade 40.68, 40.70, and then meet the 200 period moving average on this 195-minute chart and go, I just don't, risk is going to like a 50, but I don't think it lasts. Just like I don't think it lasts in the US dollar, just like I don't think it lasts in gold. I don't think this 40.68 to 40.80, whatever the level happens to be here, is going to last very long. Yeah, I just can't see it. It's not going to be full on risk on. A 50 is going to be liked by bonds less than a 75, and therefore they will go further, they will have less momentum to the downside in yield than if they did a 75. And to me, if we get up here in SPX, put spreads are going to be very much something that I'd be interested in putting on. If we look at my clean chart and enlarge it, the level that one has to look at and think is very important is this 41.26. So whether it's 40.68 or 41.26, who cares? But to me, this is going to be a very, very important level. At this level, I have a lot of put spreads, short term and longer term. I think from this level, the likelihood of a move down is much more likely than a move up. And I think this last view is supported by the Blue Angels. Basically, we're talking about retesting these tops here, and with the flatter Blue Angels, I think the likelihood then switches to a retest of the 16 level, especially because bonds will not really like a 50 basis points. It means the Fed is blinking again, or there will be doubts that the Fed is blinking again, and it's not being aggressive enough. So I think that any kind of spike up in the SPX is going to be short-lived, simply because I just can't see bonds liking a 50 unless they say something, or they give a very, very good reason for it. But that is so unlikely. I mean, what could they have learned in the past 3 weeks that they didn't know before? certainly none of the data that's come out is at all supportive of CPI having topped, and that it would come down very aggressively. The prices of commodities, yes, but that needs to be reflected, that needs to be shown, and I just can't see that that is the case. I think this last point is supported by the VIX as well. While the VIX is red or continues to be red nearly every day, why sell SPX, right? I mean, what's the hurry? But we are meeting the 200 period weekly moving average around the 2120 or 70, whatever that level is, who cares? Certainly, if it spikes down to 19 after the Fed, it's going to be a big time risk reward to the upside in VIX, and that would mean that we are topping in SPX. So that is how I see the situation. Basically, down here in VIX, to me, the risk reward switches that over the course of a certain period of time, it's much more likely to go up, back up towards 30, and it's much more likely, therefore, that SPX is going to come off from those levels that I showed you. Textbook trading, technical trading in the stocks from the 33.83 level straight back up to 36.24. Probably take it out a little bit like here next week and then come back down. I would have thought that what you want to do if you are long of the straddle here, like I am, you basically want to sell the calls when it gets up, when we get the little spike on the Fed, hopefully, anywhere above 36.50, 36.60. You sell them there and look for look for the puts that are remaining to gain in value over the course of the next few weeks, and when it gets down to 33.83, you go long again the outrights, and that's the way I'm trading it. I've updated all the levels, and really the key to the week is going to be, I think, what the dollar does on if it's only 50. I think if it's only 50, the dollar will come off. That will give a bid to the equities, and they'll take them to the levels that that are quite likely to be traded. And anywhere around the 41.25 area, as I showed you earlier, is going to be a very, very good short, I think. It really is as simple as that. I think at 41.25 you buy a whole load of put spreads. Anyway, all the levels are updated, and this is the gold one. I will post, of course, this file so you have it. Very good luck to you over the Fed. Have a wonderful weekend, and tweet you on Monday.